But the scenario was they had a put spread on this very famous electric car company. And I don't remember if it was earnings release or what the event was, but the investor had a spread on, and I think it was $10 wide. So they basically had $1,000 worth of risk, per option contract, and I think they had 7 contracts. So in their mind, they had $7,000 worth of risk. Well, something happened, and again, I don't remember the specifics, but it turned out that the investor woke up the next day to an assignment notice, and now they found themselves long stock, and they were long I guess it would be 700 shares of stock. And this electric car company, the share price had basically gone in the toilet. And where this investor thought they had that defined risk, defined reward of $7,000 on risk, they now found themselves, I think it was down like $70,000 in terms of on paper losses, that if they were to cover that stock loss, they would be down 70 grand. So again, it's an important concept to keep in mind. Certainly not something that happens all the time, but it does happen enough, and potentially with enough severity, that it can wipe out your portfolio, and it could turn a trade where you're expecting a very minimal loss into a significant one. So something I talk about a lot, something to keep in mind. If you have questions about that, please reach out to us. So let's go over some of the key takeaways that we talked about today. When we're buying options, the maximum risk is going to be equal to that which we put into it. Just like any other investment, stock, for example, you can't lose more than you put into buying the stock. Same thing with buying options. You can't lose more than you put into that as well. But to reduce that potential risk, you can turn around and turn a long call or put into a debit spread. It reduces your upfront risk. It reduces your upfront cash outlay. It reduces your break-even point, so you've got a lower threshold or a more favorable threshold in order to start turning profits. But as risk and reward go hand in hand, less risk means less reward. So the trade-off is we're capping our potential rewards to possibly a more realistic level. Remember, we don't think the stock's going to go to infinity or down to zero. We think it's going to go 5% or 10%, something like that. Again, forecast, magnitude, and timing. That is where the strike selection comes in, forecast, and certainly magnitude. That long option is going to provide the floor or the ceiling for where we think that stock is going to be. And then our short option is going to be the opposite. That's going to be where our expectation is going to be. So, definitely something we can do: reduced risk, reduced reward, defined risk, defined reward. But again, that definition, that defined risk and reward, only occurs within that spread. Any change in exercise or assignment is going to completely change the composition of that risk and reward with the spread.